Are we finally headed for that valuation correction that not only us, but many have warned equity investors about? It's Tuesday, November the 18th, and this is Markets with Megan. If you like this podcast, please subscribe, hit the alarm bell, share with friends, family, or colleagues, anyone who might be interested on what is that economic data and what does it mean for the markets. Specifically today, we're going to focus though on the markets because we have seen volatility as measured by the VIX index spiked to levels that we haven't seen since really that Liberation Day volatility back in April. We are matching right now intraday the level we saw a few weeks ago in October. But aside from that, you've got to go all the way back to the big decline we saw in April after Trump announced those tariffs. We're seeing this volatility pick up for really 5 reasons. First of all, valuations had been very stretched in the S&P 500. The S&P 500 price to earnings multiple, when you consider the forward earnings, the next 12 months, had reached 26 times. If you take out the pandemic distortions in PE multiples, you've got to go all the way back to the late 1990s before you saw PE multiples that high. The second reason is there's fear that we're in an AI bubble. We've been warning a bit about bubble-like characteristics in what we've seen in the markets. We haven't necessarily said we're in a bubble like a .com bubble, but we have been concerned valuations are really getting stretched here. Investors need to be convinced with these big tech names where valuations ran very high that they're being rewarded and the money that's been spent is going to translate into future earnings. We'll get NVIDIA earnings tomorrow on Wednesday the 19th, and the markets will be paying very close attention to that. The third reason is the economy. There has been, the government's been shut down, so we have not had the government data on the economy, but we've been watching some of the private reports that are being released. And the Federal Reserve has been paying very close attention to their regional banks and what they're saying about economic activity. And unfortunately, it's showing the economy slowing, the consumer slowing, and that is causing some fear amongst investors in the equity market. You saw it today with even Home Depot that did warn consumers really aren't spending that much on home improvements anymore. So that's showing that budgets are starting to get tightened here a bit. The fourth reason is this mixed rhetoric we're getting from Federal Reserve officials. Some say they want to cut rates, some say they don't. We don't have the government data to really get a clear picture. So the odds of a Fed rate cut in December have dropped from about 100% all the way down to 40%. And that's because some of the private sector data we've seen is a labor market that's weakening, not completely collapsing, but inflation that just continues to be stubborn. So it does give the Fed the flexibility to maybe, hey, let's hold on. Let's wait and get some more of this government data before we make any decisions on interest rates. And really the last reason has just been this overall risk-off mentality. We've seen it in, for example, Bitcoin, which we have often warned investors is a very risky investment, regardless of those that tell you it's a hedge against the equity market, it's a hedge against inflation, it's a hedge against the dollar. Well, it hasn't proven to be anything like that this year. In fact, we're now in the second bear market this year alone in Bitcoin, and that's on top of 2 additional 10% corrections in Bitcoin. So that does create some fear. And remember, Bitcoin's been a momentum trade just like these AI names. And when you get fear on the streets, when it comes to momentum, you tend to see indiscriminate selling there. And we're seeing that right now. The other concern that's been out by a lot of economists and also analysts is not only around private credit, but then also just these PE multiples and how stretched that they are in the specifically U.S. large cap market. So let's just break down some of the damage we've seen thus far. The S&P 500 through today, so about halfway through the month, is on pace to have its worst November since 2008. And remember, we tend to be in a very positive seasonal period period in October, November, and December. The small, mid-cap, and NASDAQ, this is the part of the U.S. equity market that's feeling the most pain. The NASDAQ is down about 7% from its recent high in October. The Russell 2000 is down about 8%. But when you look at the growth sectors, when you look at the large cap growth, the Russell 1000, that's down about 7%. When you look at the mid cap growth, that's down about 10% from its recent high. So that's where you're getting more pain there because of the concern about the economy as well as the stretched valuations. And as we mentioned, we're seeing just Bitcoin continue to get hit here. We are seeing treasury yields down a little bit on this risk off sentiment, and we're seeing gold get a bit of a bit here in the markets. Now we'll come back and continue to update you on the market developments as we see them. The biggest thing this week will not only be NVIDIA earnings tomorrow on Wednesday, but Thursday with the September jobs report. So we're finally getting back to some of that economic data that does give us a clearer picture here on the economy, specifically for investors, and what's the appropriate price to pay for these investments. Thank you. And if you want to see a history of our podcast, you can go to marketswithmegan.fm.